Hello Liberty Universe family, welcome back to our channel where we explore the fascinating world of finance and investing. You know, I love breaking down complex financial topics and making them accessible to everyone. Today, we're diving into the exciting world of the stock market. Whether you're a seasoned investor or just starting, understanding the stock market is crucial for building long-term wealth. And trust me, there's always something new to learn. We'll be uncovering some truly intriguing secrets that many people, even experienced investors, might not know. We're talking about the history, the quirks, the little-known facts that make the stock market such a captivating and potentially profitable arena. So buckle up, grab your notebooks, and get ready to level up your investing knowledge. Let's get started. The stock market, as we know it, has a surprisingly long and rich history. It's older than you might think, and its roots run deep. Believe it or not, the stock market predates the founding of the United States. That's right. The world's first official stock exchange was established way back in 1602 in Amsterdam. Can you imagine that? Merchants and investors gathering in the heart of the Dutch Golden Age, laying the groundwork for the global financial system we know today. It's a testament to the enduring power of investing and the human desire to build wealth. The Amsterdam Stock Exchange, originally known as the Amsterdam Bourse, was a game changer. It provided a centralized and regulated platform for trading shares in joint stock companies, paving the way for modern capitalism. Now, let's fast forward to the birth of the New York Stock Exchange, or NYSE as we know it today. The year was 1792, just a few years after the United States gained its independence. The young nation faced its first financial panic, a story for another time, but it was in the wake of this crisis that a group of 24 stockbrokers came together to create a more stable and organized market. These forward-thinking individuals gathered on Wall Street, under a buttonwood tree no less, to sign what became known as the Buttonwood Agreement. This historic document marked the beginning of the NYSE. From its humble beginnings, the NYSE has grown into the world's largest stock exchange by market capitalization, a true testament to the power of American capitalism and the enduring appeal of the stock market. All right, let's talk numbers for a second, because in the stock market, size definitely matters. As of 2023, the total market capitalization of all publicly traded companies worldwide reached a mind-blowing $111 trillion. That's trillion with a T. To put that into perspective, it's like taking the entire US economy and then adding another whole US economy on top of that. And then, for good measure, toss in another few trillion just for fun. That's how massive the global stock market really is. Now, you might be thinking, Graham, that that's a ridiculous amount of money. Where does it all come from? Well, it comes from millions of investors like you and me, pouring their savings, their 401k contributions, their hard-earned cash into the market, hoping to grow their wealth over time. And it's not just individuals. We're talking about giant institutional investors like pension funds, hedge funds, and sovereign wealth funds. They're all playing in this massive arena, buying and selling pieces of companies, driving those valuations higher and higher. But here's the thing. Even though $111 trillion sounds like an impossibly large number, it's actually grown significantly over the years. Just a decade ago, the global market cap was less than half that size. This incredible growth is fueled by a number of factors. New companies going public, existing companies expanding their operations, and of course good old-fashioned investor optimism. It just goes to show you the power of the stock market as an engine for wealth creation. But remember, while it's exciting to see these massive numbers, it's important to stay grounded. Don't let the sheer size of the market intimidate you. Focus on building a solid investment strategy, diversifying your portfolio and investing for the long term. Because whether the market is at 111 trillion or 200 trillion, the fundamental principles of successful investing remain the same. When we talk about the global stock market, not all markets are created equal. The US stock market reigns supreme. As of 2023, US companies account for 59% of the world's stock market value. That's market dominance. But why is the US market so dominant? Centuries of innovation and a massive economy, plus a robust financial system and the US dollar. But the US market isn't the only game in town. Stay tuned for more. The global stock market is massive, with over 60 exchanges worldwide. 16 of these exchanges dominate, holding 87% of the market cap. But smaller exchanges offer untapped potential and unique opportunities. Diversify and explore these hidden gems to supercharge your portfolio. The world of stock market investing is vast and evolving. Don't be afraid to explore and seek out hidden opportunities. Let's talk about the Dow Jones Industrial Average, or the Dow. Created in 1896 with 12 companies, it's now 30 major US companies. The Dow is a benchmark for the US stock market. It shows market trends and overall health. Black Tuesday, October 29, 1929, marked the start of the Great Depression. Millions lost their savings, businesses crumbled, and the effects were felt for years. Market crashes are painful but natural. Learn from history to mitigate risks. Long-term diversified investors can weather these storms. Let's talk about bull markets, those exhilarating periods of prolonged growth and optimism. The longest bull market in US history began in March 2009 and continued until February 2020, over a decade of almost uninterrupted growth. The S&P 500 more than quadrupled in value. Companies flourished, investors saw incredible returns. This bull market ended with the COVID-19 pandemic. Its duration reminds us of the stock market's growth potential. Time in the market is often more important than timing the market. Stay invested to benefit from extended growth periods. Now let's talk about something that gets everyone excited: returns. When you hear about the stock market, you probably hear stories about people getting rich quick. And while that's possible, it's not the norm. What is the norm is the long game. Historically, the S&P 500 index has averaged an annual return of about 10%, but individual years can vary significantly. Some years the market is up 20%, some years it's down 10%. It's a roller coaster, but the key is to stay invested for the long haul. Think of it like this. If you invest $10,000 today and leave it in the S&P 500 for 30 years with an average annual return of 10%, you'd end up with over $170,000. That's the power of compound interest. Your money's making money, and then that money is making even more money. It's like a snowball effect. But remember, past performance is not indicative of future results. The market can be unpredictable, and there are no guarantees. However, history has shown that over the long term, the stock market tends to go up. So if you're patient and disciplined, investing in the stock market can be a great way to build wealth over time. Let's dive into some of the craziest moments in stock market history. Take March 24th, 2020. The world was in the grips of the COVID-19 pandemic. Businesses were shutting down and the stock market was in free fall. Then something incredible happened. The Dow Jones experienced its largest single-day point gain ever. It was a truly historic day. Ever heard of a stock split? No, it's not some Wall Street magic trick. It's when a company increases its shares. Think of it like cutting a pizza into more slices. More slices, same pizza. It makes stocks more affordable and can attract more investors. It's all part of the game. Let's talk about the flash crash of 2010. May 6th, the Dow Jones plunges nearly 1,000 points in minutes, a full-on market freefall, panic, high-frequency trading, and market orders gone wrong. The market recovered within the hour. A wake-up call about today's fast, interconnected markets. Let's dive into high-frequency trading, or HFT. Algorithms battle at lightning speed, executing millions of trades per second. HFT firms are like cheaters exploiting tiny price discrepancies. They make micro profits on massive volumes. Some say HFT adds liquidity. Others worry about unfair advantages. Regardless, it's a major force in the stock market. Let's rewind to 1971. The Nasdaq emerged as the world's first electronic stock exchange. No more yelling traders. This was digital trading. It made trading faster and more efficient, paving the way for today's online trading platforms. The Nasdaq revolutionized the stock market. Let's talk about market capitalization, or market cap. It's the total value of a company's outstanding shares. Multiply the share price by the total number of shares. It helps gauge a company's size and value. Use it to compare companies and make informed decisions. Diversification is crucial for any investor. Don't put all your eggs in one basket. Spread your investments across different asset classes. This reduces risk and smooths out your portfolio's performance. All right, let's dive into something that can make or break a stock's performance earnings reports. These quarterly reports are like a company's financial report card, giving you a peek under the hood to see how the business is doing. Essentially, earnings reports show you how much revenue a company generated, its expenses, and its net income or profit over a specific period. They also usually include things like earnings per share, EPS, which is the profit allocated to each outstanding share of stock. Now, why should you care about these reports? Because they can significantly impact a company's stock price. If a company smashes earnings estimates and shows strong growth, investors get excited and the stock price tends to go up. On the other hand, if a company misses earnings estimates or reports disappointing numbers, investors might get spooked and the stock price could drop. Understanding earnings reports and how to analyze them is essential for making informed investment decisions. All right, guys, let's talk dividends. Imagine owning a little piece of a company that's actually making money. You'd want a cut of those profits, right? That's exactly what a dividend is. A cash payment distributed to shareholders, usually on a quarterly basis. Now, not every company pays dividends. Some companies, especially younger ones, prefer to reinvest their earnings back into the business for growth. But established, profitable companies often choose to share a portion of their profits with their investors. That's you. You buy a rental property and every month you collect rent. Dividends are kind of like that, a stream of passive income from your investments. And over the long term, those dividend payments can really add up. Returns. Remember that $10,000 investment we talked about earlier? With dividends reinvested, you could be looking at a significantly larger nest egg down the line. It's like compound interest on The stock market doesn't operate in a vacuum. It's influenced by the overall health of the economy. Economic indicators give us a glimpse into how the economy is performing. Think of it like checking vital signs. Unemployment rate shows how many people are out of work. Low unemployment means a strong economy. Inflation measures the rate at which prices are rising. High inflation can make investors nervous. GDP measures the total value of goods and services produced. A growing GDP is a good sign for the economy. Interest rates are set by central banks. These indicators can impact stock prices. Higher interest rates can hurt company profits and stock prices. All right, guys, let's dive into the world of short selling. Short selling is betting against a stock, hoping its price goes down. You borrow shares, sell them, and buy back at a lower price. If the stock price rises, losses can be unlimited. It's risky and not for beginners. But if you believe a stock is overvalued, it can be profitable. Let's talk about mutual funds. Imagine a buffet with diverse dishes. Mutual funds are like that. They diversify your investments, managed by professionals. Diversification manages risk. It's like a safety net for your money. Consider mutual funds for a diversified portfolio. Now let's move on to exchange-traded funds, or ETFs for short. Think of ETFs as the cool younger sibling of mutual funds. They offer that same great diversification, but with a modern twist. See, ETFs are traded on stock exchanges, just like individual stocks. This means you can buy and sell them throughout the trading day, giving you more flexibility and control over your investments. With mutual funds, you're stuck with the price at the end of the day. ETFs also tend to have lower fees compared to mutual funds, which can make a big difference in your returns over the long run. And trust me, every dollar saved on fees is another dollar working for you in the market. So if you're looking for a diversified investment option with the flexibility of stock trading and potentially lower fees, ETFs might be the perfect fit for you. But again, do your homework, understand the underlying assets, and make sure they align with your investment strategy. Let's talk about interest rates. Interest rates are like financial gravity. They can pull your investments up or down. When the Fed raises rates, borrowing costs rise, potentially hurting stock prices. Lower rates can boost the economy and stock prices. Stay informed about the Fed's announcements and economic indicators. All right, guys, let's talk about beta. Beta measures how much a stock's price moves relative to the market. Higher beta means more volatility, lower beta means less. It all depends on your risk tolerance and strategy. The price-to-earnings ratio, or PE ratio, is one of the most widely used valuation metrics in the stock market. It essentially tells you how much you're paying for every dollar of a company's earnings. To calculate the PE ratio, you simply divide the company's current share price by its earnings per share. So, if a company has a share price of $100 and earnings per share of $10, its PE ratio would be 10. Now, a high PE ratio could indicate that investors are expecting high growth from the company in the future. They're willing to pay a premium for those potential future earnings. On the other hand, a low PE ratio could mean that the company is undervalued, or it could signal that investors are not very optimistic about its future prospects. Remember, there's no magic number when it comes to PE ratios. It's just one piece of the puzzle. Let's talk about market sentiment, a huge role in the stock market. It's the psychological mood of investors, driven by news, data, and gut feeling. Optimism leads to a bull market, rising prices. Fear leads to a bear market, falling prices. Market sentiment is contagious. Stay informed, do your research, and make rational decisions. All right, let's talk geopolitics. You know, those big global events that seem a million miles away but can actually impact your portfolio. We're talking elections, trade wars, you name it. These things can make or break investor confidence. And that translates directly into market moves. Remember back in 2025, Trump dropped those tariffs on foreign cars and bam! Automaker stocks took a nosedive. That's the power of geopolitics. You've got these huge forces at play, and even the rumor of a trade war can send shockwaves through the market. Now, I'm not saying you need to become an expert in international relations, but you've got to stay informed. Keep an eye on the headlines, especially anything that could impact the companies or sectors you're invested in. Remember, knowledge is power. The more you understand how these global events can impact the market, the better equipped you'll be to navigate the ups and downs and come out ahead. Ever tried to sell something quickly but nobody's buying? That's a liquidity problem, and it exists in the stock market too. Basically, liquidity is how easily you can buy or sell an asset without drastically affecting its price. Think of it like this. A blue chip stock, that's like selling a popular sneaker. Tons of buyers and sellers, you can get in and out easily, but a penny stock, that's like trying to sell a vintage Beanie Baby. Might be valuable to the right buyer, but finding them takes time. High liquidity means a more active market, which is generally a good thing. It means you're less likely to get stuck holding the bag if you need to sell quickly. Low liquidity, you might have to lower your price to attract a buyer, potentially taking a loss. So, how do you find liquid stocks? Look for companies with high trading volume. That's your key indicator. And remember, liquidity can change, so stay informed and adjust your strategy accordingly. Let's talk about the referees of the stock market regulatory bodies. They keep things fair and efficient. The SEC is the big dog in the US. They protect investors and ensure fair markets. Independence from political influence is crucial. Regulatory bodies are essential for a healthy market. We've covered the stock market's past, but what about its future? Predicting the market is nearly impossible, but emerging technologies will shape investing. AI, blockchain, and automated trading are rising. These advancements present risks and opportunities. The stock market is constantly evolving. Stay informed and never stop learning. Okay, I've got one more stock market fact for you, and this one is wild. There's actually a pirate stock exchange. I'm not kidding. In 2009, in Somalia, a stock exchange was established for pirate operations. You could buy shares in a pirate gang and profit from ransoms, high-risk, high-reward investments, right? It was informal, unregulated, and incredibly risky, attracted investors from other countries too. The allure of pirate booty was strong. Finance can be strange and diverse. Unexpected opportunities and risks are out there. Sometimes those risks involve swashbuckling pirates. And there you have it. 30 fascinating facts about the stock market that every investor should know. If you found this video informative, please give it a thumbs up. Subscribe to Liberty Universe for more financial insights, and hit that notification bell so you never miss an update. Until next time, happy investing.